From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for the first Friday of June 2026. Your first-place Milwaukee Brewers are in Denver this weekend with the Colorado Rockies. But there's plenty of stuff to do here in town. Pride Fest is underway at the Summerfest grounds through Saturday, and for something completely different, it's the Milwaukee Highland Games at Croatian Park in Franklin. They'll have bagpipes, a caber toss, where basically the competitors hoist and flip telephone poles. And if you're hungry after telephone pole tossing, there's a haggis taco stand and an eating contest at 2 p.m. I could never be that hungry. Okay, enough about haggis. On Friday and Saturday, this village of Wauwatosa has an outdoor painting tournament. Wander through Tosa Village and watch artists paint and compete for a grand prize of $20,000. According to the Nature Food Journal, using a so-called health nutritional index, they've determined hot dogs are killing us. And this index says each hot dog shortens your life by 36 minutes. I may already be dead and not know it. Cheeseburgers shorten your life by 9 minutes, but French fries, and get ready for this, they add 1.5 minutes to your life. Well, they are a vegetable. Finally, on this day in history, in 1939, Milwaukee's unofficial anthem, the Beer Barrel Polka, hit number 1 on the singles charts. On the podcast today, we have Dave Sandstrom, Tom Pappenfus, and with a look back at the week, here's Kyle Tetting.
Well, thanks, Max. I was shocked to learn when I got married that, in fact, French fries are not vegetables, that they always were growing up. So, tough week overall for the markets. Nasdaq down 4.7%, closed today at 25,709. The S&P down 2.6%, down 196 points this week, almost all of it on Friday, closing at the bell at 73.84. The Dow almost squeaked out a positive number this week, losing just 166 points after falling 695 points on Friday, down 0.3% for the week. For the year, Nasdaq still up 10.9 despite the tough week. The S&P up 8.4, and the Dow Jones Industrial Average up 6.5%. Dave, hard not to look at a tough week for the markets and really try to back into what went wrong. We were on the verge of 10 consecutive positive weeks for the S&P 500. If not for those pesky couple of down days, would have been really the longest stretch we've seen for the S&P since going back to the 1980s. A really, I think, meaningful stretch of positive returns for the market. And then we got a really positive jobs report, and all of a sudden the market's taken off the wrong direction. One of those cases, perhaps, Dave, of good news being bad for markets more broadly.
Yeah, it's amazing how things can change so quickly, isn't it? I mean, we come off of 2025 when all the hand-wringing was based on the fact that we had a slowing jobs market. And that's where the concern lied. And we almost ended up with a kind of a net break-even last year in adding jobs. And now here we are just 5 months into the year, and I think we're up approximately 500,000 jobs already this year. And some big numbers. Surprising to the upside today at the 172,000 jobs added. Some other good news in there in that report, too, that shows that the pay increases are up about 4.3%. But anyway you look at it, Kyle, this is going to put pressure on interest rates. And I think the markets today reacted to the fact that, the Fed's going to be in a position here where they might get backed into that corner of having to tap the brakes a little bit at some point this year.
Yeah, Tom, it's all about earnings and interest rates. We got a first quarter earnings season mostly under our belt now, and it was this exceptional set of responses from corporations, far outpacing our expectations for earnings. But as Dave points out, well, all of a sudden now we're beyond those reports, and now interest rates come back into focus. And when you look at some of the biggest responses we saw in the market this week, those growth stocks in the Nasdaq, the most susceptible to the pressure we get from interest rates.
Yeah, I think it's important to note the nature of what was selling off the harshest. And it's certainly the names that have the highest PEs, the ones that have really run up. It's namely the semiconductors that got pummeled the worst right now, and probably to Dave's point about interest rates. We are expecting perhaps a rate hike. The markets are futures pricing in a hike by the end of the year. So that's going to hit, to your point, the highest valued companies that are out there. And so I think it's important to note when you look at the S&P 500, I don't think it's certainly not panic time. There's still the majority, it's become a smaller majority, but of stocks in the S&P 500 are still higher on the year. It's 257 stocks compared to 244. I do recognize that number in math doesn't quite work to 500, but that is the case right now. So I think it's definitely more of peeling back, from the names that have run up so far, a lot of profit taking happening, and just I think a lot of the investors that have been in those high names looking perhaps for other opportunities, and as we're looking at some major IPOs as well coming up.
I think a lot of the expectation for why we were so willing to pay up for these stocks was that our current administration had talked about lower interest rates. There was an expectation that, we'll get inflation under control. We may see a bit of economic weakening, and then lower rates will ultimately create even more demand for the market because the competition's not all that great. We talked a little bit about that on the podcast last week, kind of this difference between the earnings yield on the S&P and what you can get buying bonds. And all of a sudden, with the market selling off a bit, the earnings yield looks a little more attractive again maybe than it did a week ago. But the real factor here is that those rates are a discount mechanism for what we're supposed to be willing to pay for the stock market. And now with inflation continuing to be a problem, the market really coming around to the idea that it might be a problem for a little while longer, that maybe the Fed will in fact raise despite what has been kind of put on Warsh by the president and by the administration more broadly. Well, I think perhaps that's a sign that maybe we shouldn't be quite as willing to pay up as we had been, even if, again, the rest of the story stays intact. And then, Tom, one of the things you and I were talking about before the podcast was how much shift there is right now in demand. Broadcom reporting some less than encouraging news earlier in the week on data center demand. And we're seeing kind of across those technology businesses as a result, a reflection of how that demand continues to shift. Yeah,
I would say that especially right now, when we look at portfolios with our clients, I call it right away that on average client accounts, if you have any form of risk management diversification, there's been a lot of names that have been ignored. But I certainly preach a lot of patience right now because when you look at what happened today with the markets, it was just an exact polar opposite. With the Nasdaq being down significantly today, while the Dow did outperform much better. I think you're going to start to see, investors looking for other opportunities, looking for other chances to kind of, I guess, stay away from some of the names that might bear some risk with rates going potentially higher.
Yeah, and I think that theme started, if you go back into the beginning of the year, don't forget, that was the rotation from growth to value started before we even talked about the Iran war, right, and inflation spiking. Remember at that stage, we were thinking, inflation's coming down. People were kind of thinking, maybe now's the time to move, take some profit out of growth stocks, move to value. And then of course everything kind of blows up. We got a war going on, and now we got the significant reversal in the jobs market this week. But now all of a sudden you get the same theme back, right? It's going to be a rotation out of growth stocks maybe for a bit, and now it's because it's that sensitivity to interest rates. And Kyle, as you pointed out, that's a discount mechanism for stocks, and the higher the stock is valued is the more you, I think, have to take into consideration that the discount.
The driving force behind the economic news this week was all labor market. I think it is kind of that point in time in which we largely get set adrift to just look at headlines for a while. And so the more encouraging news on the labor market, I think, also supported some of the conversations we've been having around spending. Dave, we had MasterCard's executive come out this week and talk about how much more demand they are seeing for their product obviously being that little plastic card that sits in everybody's wallet that they use when they run to the store. But they are talking about demand still being there from consumers, even as consumers say they don't feel great. And what's interesting is we had been talking a bit about this K-shaped economic recovery, right? That the maybe top half of spenders were spending even more, while the bottom half were feeling it with even more pain. And yet we're seeing some signs that the spending has been stable really across income spectrums. And Dave, you and I were talking maybe about what some of that is coming from, and in particular looking at the trades.
Correct. We're seeing a massive increase in incomes at the trades level due to primarily to data center demand. When you look at what it takes to build, one single site, one that we have close to home here, Port Washington, just read a report that right on site right now you have 600 pipe fitters and 100 electricians in that one project. So the demand for the trades is at maybe an all-time high here, and you're looking at significant wage increases. Reports would suggest that about 20% of the labor market is in the trades right now. So that's a fairly reasonable percentage, and would have some impact on overall spending when you're talking about somebody in that area getting that kind of increase in their pay.
Yeah, I think huge, and clearly seeing, despite the fact that not everybody feels great, that the spending is still taking place. One other area that I think people are looking to spend some money in the next week here is with this SpaceX IPO that we seem to have to talk about somewhat regularly. Tom, I won't ask the obvious question, should I buy SpaceX? I think probably not appropriate for this general setting. But I think the bigger question around these types of IPOs, the bigger question around how you would do it if you're going to do it, are you getting that question from clients? I know many of our advisors are more broadly, should I do this? How can I do it? What do you think of what you're seeing from kind of this SpaceX IPO? Set, by the way, to launch next week, Friday. So hopefully this is one of the last times we have to talk about it for a little while.
I got the question from one client, but we talked about it, and I think as we have kind of, from my experience when seeing these IPOs, and I think all of us can kind of speak to witnessing and being a part of them in the past, is that generally the way they work is the price will likely run up quite a bit in the short term, but then you get the early investors, the people that are in their pre-IPO, they're looking to get out at a premium. They're looking at least to cash in some, and because they're at a much, much lower price than you and I and the general public will see that price at. So generally, whatever you see on that first day, at some point in the next, who knows, could be in a month, 6 months, whatever it may be, but you will likely see a better price. So if you do really want to own it, I always try to preach to my clients to just exercise patience. Don't be ready to jump in that day. You're going to be hopping in line with a lot of other people, and you're not going to get possibly the best price in the near term.
And I think that's the most critical thing to realize. And I think a lot of times average investors don't realize that it isn't as simple as just saying, I place my order at the open, I get that open price. That's not how it works. It takes considerable effort to fulfill all these orders, especially in something like this where demand is probably going to be record-breaking for this. So it wouldn't be unusual to see a doubling of that price on that opening day. I mean, it is, that's the type of thing we're hearing right now, is that demand is just going to be absolutely unbelievable.
And just related an anecdotal story. I mean, my own mother, back when Facebook went public, that was, I think one of the other big popular ones, and it opened up at around 38, I think, or maybe even lower, but then it was up at around $38, $42 you wanted to buy it. I think she did ultimately get it, and it worked out long term, but at some point in the next 6 months, it was down to $17 a share. So there can be opportunities out there if you have patience.
The 50 years ending 2021, 9,000 operating publicly traded companies went the route of initial public offering. 60% of those businesses 3 years later were not even close to remotely profitable from their closing price on the first day. And some of the things you hit on, Dave, are that you're not going to get that IPO price unless you are part of the subscription. The good news with SpaceX is that they have committed more shares to retail investors. Historically, 5 to 10% of IPO shares go to the retail investors. Retail investors are very simply the folks like us, right? The mom and pops, the individual investors looking to get shares into their own portfolio. And again, historically, that's maybe 5 or 10% of an initial public offering. With SpaceX, a little closer to 30% is what they're shooting for. But even then, the stories we are hearing from the market makers, the analysts, the folks looking at this business, They're predicting a business that is maybe one of the greatest things we've ever seen. The problem is that great businesses aren't always great investments. And I think that's a distinction that often has to be made for investors, is that it isn't enough to say, hey, this is a business I want to own. At what price? And that's really the key, I think, to this conversation is if you've got to pay 10 times more than what it should be worth, it doesn't matter how good the business is, it may not be a great investment. And so I think the thing we have preached is, if you're not already in, if you haven't bought one of those ETFs or mutual funds that have meaningful exposure, it's probably okay to be patient at this point. Yeah, you're going to miss the euphoria that came in that first day of trading. There is a high likelihood you wouldn't get to participate anyways. And even if you did, there's no guarantee that you can get out of those shares fast enough to get the full benefit of the pop. And so, again, I think there is this challenge in seeing an obvious opportunity, or what appears to be obvious for so many, but not really having an understanding yet of how it's going to price. Well, with that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.